If you want to become a consistently profitable trader and make your first 5 or even 6-figure month in trading profits, in this full guide, I'm going to go over everything you need to know in 5 simple steps how to trade with edge and take winning trades just like these. The first step to becoming a consistently profitable trader is understanding the fundamentals of edge. What is edge? At its most basic core principle, it is market participation. The market's job in understanding what the market's job is at the beginning of understanding what edge is. So if you look at a stock that is typically trading a 5 or 6 point range in a particular day, let's say, and then there's a day that it moves, say double that, like 14, 15 points. Which day do you think is going to be easier to catch a trade? Say you're trying to catch 4 or 5 points on a specific setup. It's going to be way easier to trade it on this day versus trying to fight the day that it's trading in its typical range. On the day that it's trading its typical range, you are going to be competing with market makers, HFTs, algos. Really, we call this the house. You're competing with the house and what really the market's job is, which is pricing in information. So the market is constantly working to price in information and so where suppliers and demand for certain stocks are meeting. So since the market's job is to price in information and be efficient, when we're focusing on stocks that are trading double their range or more and trading heavy volume, what we're doing is we're aligning with an inefficiency. We're aligning with the market trying to price in that information as quickly as it can. And that is a fundamental edge for us. We're immediately putting the odds in our favor by focusing on days like these versus the average range day. There's a lot of ways to find edge in the markets, but this is a very core concept that every trader should know. And to be honest, most of the traders I talk to are not doing this. And this will put you ahead of probably 95% of traders. Most traders are going to be taking something that they learned from reading a chart or an indicator and building a strategy off of it and applying certain things to the wrong thing. And understanding this first basic fundamental on sticking with stocks that are trading in expanded range is extremely important and really the framework for what everything else we're about to go over. So an example of what this looks like is, say you have a stock like SMCI. This stock is trading on average, which we can look this up using an indicator, quickly tell us that the stock typically trades $38 per day. This is based on a 14-day average. So the stock will typically move 40 points per day. And if you look at it on that, this is a daily chart. Imagine trying to trade the stock every day in this range. Over the last 2 weeks, the stock has moved how it typically would, about 40 points, and it's really gone about 40 points total in 2 weeks. So in this section, you're really just fighting against heavy competition. You're fighting against the market just pricing in what the stock is currently valued at. Well, then if you focus on the day that it's moving like this, imagine how much easier it's going to be when it's moving 100 points to catch 10 or 20 on a certain trade versus trying to catch 10 or 20 points on a day that it only moves 40. So you do the math. So if you look at this on a smaller time frame, you can see that the stock had breaking news and sold off nearly 100 points in 10 or 15 minutes. Really impressive. So once this moves, it sets up different trades, which we'll talk about exactly the trade that we focus on that makes us the most money a little bit later. But for now, this is just one simple example of what we're talking about here. So the next part is technical analysis. It's really important to know just some basics on technical analysis. You don't need to be a charting expert. You don't need to be a master in technical analysis, but there are some basic concepts that are really important to know, such as support and resistance levels, what makes them important levels, and what are some little tips and tricks defining the biggest levels. Well, first, understanding the basics of technical analysis are going to be really helpful, and it's really not too hard. You don't need to be an expert, but here's a quick example of what support and resistance means. So a stock that is trading, say, in a certain type of range and comes up and tests the same level more than once, say this $150 level, this we call a resistance level. So you have resistance because price remembers. You have supply and demand meeting at a certain price point. So people agreeing on price at 150, and it has a memory. You'll learn this in trading that price has a memory. And when it tests certain spots, if there are not any buyers above that level, then the stock will then fall into what we call support. So support would be a level below that is tested multiple times that price also has a memory of and finds buyers. So if the price is too expensive at 150 and the market agrees, the price will then fade and gravitate towards better levels, which in this case or this example is around 130. So this is your basic concept of what support and resistance are. So what makes one support or resistance level stronger than another? There are a couple things that are really important to know. So the number of tests is important. Multiple time frames are important. The measured move off the level. So all these things are going to be really important to look at when determining what level a key level is. So let's dive in to some examples of what this looks like. Okay, so an example of a support and resistance level or charting would be a look at Tesla. So if we look at the Tesla daily chart, we can quickly find a couple levels that stand out. In particular, we have a level at 235 where price going all the way back to June of 2023 has tested, and you can see over the history price has respected this spot quite well. More recently, it has multiple tests. You have a test 1, 2, 3, 4, 5, 6, 7, multiple tests at this 235 level. So price, every time it reaches 235 in this period of time, it has seen a rejection in the most recent price action history. So with Tesla, you can see that 235 acted both as support and multiple times in recent memory has acted as resistance for the stock. Several times the stock has tested this spot and has been met with no buyers to push the price above 235. So with this important resistance level, we can see going back to our 3 points of number of tests, which Tesla has, then we want to look at the measured move off that level. So you can see when price tested 235, the stock dropped 22%. This time when it tested 235, it moved 10%. So it's getting very big reactions. Price tested as support here, and the price bounced 13%. If you go back even further, you can see how the stock has reacted in several different spots, moving 16%, sometimes 10%. The point being that it has had multiple tests. It also has had big measured moves off of that key level. And then the other point is multiple time frames. So if we go down to smaller time frames, you can see that the price also has tested numerous times on the smaller time frame. So with different time frames of a stock, it's just going to help you see a little closer and look on individual days to see how the price action reacted. For example, you can see on the 30-minute chart that the price actually got up to this 235 level on this day several times within that day. Whereas when we look at a daily chart, you're going to see that only be represented as one test. But it's important to look at multiple time frames like the 30 minutes, the hourly chart. You can even go out to like the weekly and monthly. This is something that I do with every chart that I analyze. I'll start zoomed out and then work my way in. So starting even as far as monthly and then working into the weekly chart, then the daily, and then the hourly or 30-minute. And what that's going to allow you to do is just see if there are more tests and see how price has respected that certain level of interest. Another example of this be Meta. So if we look at Meta, you can see that the stock price in recent memory has made an all-time high and then moved 18%, over 100 points down. And then on the most recent test, price got up near the all-time high and sold off 8%, almost 9%. And then you have multiple tests. So we have a test here, we have a test here with big measured moves off of it. And then we also get more validation. So once the price got up again, we had an initial reaction, not once, but 2 days in a row. So if we go down into the 30-minute chart, for example, you can see here before the breakout that the stock price had tested multiple times and could not clear. So once it finally cleared, then you have new buyers entering the market, and the market is rushing to price in the stock as quickly as it can. So you have more demand for the stock, pushing the price to new levels. All right, so getting into indicators, what indicators matter and how to use them. A quick note on indicators. I will say most traders will use indicators incorrectly. They'll use them as a way to confirm their bias rather than what they're actually meant for. Most, if not all, will typically lag price, but if used properly, can act as another checkbox in your favor for a particular setup. So here's a couple indicators and why we use them and also what they are. So relative volume, we call RVol. So relative volume is an indicator that we add to our charts that allows us to see how much volume has been traded on the stock over 21 days, and it gives us a value with over 1 being above average volume and below 1 being below average volume. So this simple indicator, this goes back to our original point at step 1. What is the fundamental of edge? This is a very easy way to see something that is moving more than it normally would. So if a stock has a relative volume elevated 2 or 3 times its normal, then this is good. This is what we want to be focused on trading. Another indicator that we use is ATR, or average true range. So the average true range is the stock's typical range that it trades on a 14-day period. That'll help us see whether or not a stock is trading above or below its normal range, which usually if it has a relative volume above 2 or 3, it is going to, if it's trading expanded range, it's going to be easier for us to profit. RSI is a relative strength index, and a lot of traders, this is a very common indicator, but I will say we use this very differently than many. We're not looking to build a strategy based off of just the relative strength. What we actually do is we look at divergences that set up, and that is an extra variable. It gives us confidence to not only take certain trades, but also to increase size, which we'll go over an example of. So these are the 3 main indicators that we look at. So let's go through an example of what this might look like on a certain setup. All right, so a specific example of what this would look like on a chart, we can go back to SMCI, and down here you have the relative volume. So the relative volume, you can see on a 15-minute chart, the multiple different days. Let's just put the extended hours on here. So you can see the different sessions that the stock trades. And the red shows that the stock was trading below its typical volume. And you can also see that the range, or the ATR, is also quite small. So the stock is trading how it normally might in a range on a normal day, and it's also trading below its normal volume. And then on the day that I had breaking news, you see that the RVol, or the relative volume, flips green and is trading, as you see, the point value over 2.5 times plus the normal volume that it typically trades. And then the range also is expanded quite a bit. For ATR, if it's helpful, there's an indicator for this on TradingView that you can add, which will show you, once you apply it to the chart, that the stock's typical range is $38. You can see today on Friday, it traded 61% of its typical daily range. If you would have applied that on this day, it would have shown well over 100%. Obviously, as a stock traded beyond double its average true range. There's also a relationship to average true range and RVol that is important to consider. So something that is trading 2.5 times its normal volume, if you see that stock trading, say, at a full ATR or a full move, say SMCI is trading at about 40 points on the day, and you see a trade set up on it, and you're asking yourself, okay, well, does it really have much more room to run? Well, the relative volume can be very helpful in telling you whether it has good odds to continue beyond its range, which in the case of this day on Thursday, it was trading 2.5 times its normal volume. So the odds of it trading beyond 100% of a typical day is much higher, therefore giving you more probability in the trade. All right, so let's talk a little bit more about the RSI. We use it a little bit differently than most traders would. We don't just use it to see if a stock is overbought or oversold. We're actually looking for hidden divergences within the price action and the relative strength index in particular. So let's start off by looking at an example of a hidden bullish divergence. So if you have a stock price that is making higher lows, and then you have the RSI making lower lows, this is a sign that the price is diverging. So simply put, stock price is trending up. And then when the stock makes this higher low, if you see that the relative strength index is lower, this is a positive divergence, which can indicate that the stock has reset enough. It still has a lot more strength left to push through its most recent high. This is a very simple concept, and we'll go over examples on a chart, but it can be extremely helpful in understanding whether or not a stock has more room to run. All right, guys, so with a hidden bearish divergence, what we want to look for is a stock that is trending and making lower highs and trending lower. You have on the RSI index, you'll see the price is, or the index rather, is making a higher high. So basically what's happening is you see that the price of the stock is trending lower. Lower high, that is obviously a sign of weakness, that is trending lower. But when you see that the RSI makes a new high on this bounce, that means that the stock has gotten overbought quickly while the stock price is not as high as it was here. That hidden divergence can help indicate that the stock has a lot more room to run. So let's go through a couple examples. All right, guys, so in the case of this Tesla trade, we have the stock price trending lower into the open on a gap down. You can see that the stock price is clearly trending lower, and in more recent here. And then when you look at the RSI index, you can see that the price makes a higher high here, while the stock price makes a lower high. This is an example where you see the price is trending very weak, and on the first little bounce that this stock gets, the RSI actually got up into overbought territory, giving you confidence that on this opening drive, which is a trade that we'll cover as an example of one that we take, gives you a lot of confidence to go short on Tesla, because you can see that it's reset enough right before the open and made that hidden divergence. So the steps to finding our best trade. So number one is pre-market scan. Number two is checking the relative volume. And then number three is checking for RSI divergences. So our number one trade we call an opening drive trade. This is when a stock has a fresh catalyst. We have a number of steps that we go through. So let's dive right into some examples. All right, so step-by-step process to find our most profitable opening drive trade. The first thing you're going to do is have a pre-market screener set up that's going to find stocks that are gapping up or down 3% or more or less. The second thing you're going to do is check the relative volume and then look for RSI divergences. So let's get into a example. So step one is finding a stock that's gapping down or up 2 or 3%. In this example, we have Tesla gapping down over 3% from the prior day. So the stock was gapping down 8%, so outside of its normal range. Step two is look for the relative volume, which you can see is elevated above 3, which means that we have 3 times the normal volume trading on the stock. And this is in the pre-market session. The third step we're going to look for is an RSI divergence. So as we previously went over, you can see Tesla is trending lower, and then the RSI has reset. It made a higher high while the price made a higher low. So now that you have all 3 variables in your favor, this is when our most profitable trade sets up an entry. So in this example, we have Tesla on an opening drive. We're looking for a move right under the support level around 224. The significance of this trade is that it has all the variables that we look for in the trade. It has a key level at 224 that is tested multiple times as support. It has the pre-market gap, has the elevated RVol, and then also a strong hidden divergence that is bearish on the RSI. This trade we took on the break. We bought put options, and this sold 4%, another 9 points, very direct. One other notable thing about this setup was that the little bounce that you had here also helped to reset the RSI, when in reality the price did not move very much and it got reset a little bit, giving us conviction that this still had more room to go, in which case it did. So we saw another 7-point drop following this quick flush off the open. Let's go through some more examples. So Oracle is another example. The stock is seeing elevated relative volume, in this case significantly elevated above normal, and you can see that almost 100 times the normal volume that it typically would trade. But then looking at the RSI, you can see that the price of the stock is up here around 152, 153, and the stock price is relatively flat and sort of flagging. And as it starts to push up into the open, if you look at the RSI is trending lower while price is moving sideways and then up. Signifies that even though the stock gapped up 9%, it still has more room to run and more strength left in it. This actual consolidation period was a way for it to reset the relative strength index, put in that bullish divergence, and then you can see the explosive move that we got right off the open. This move, all in one candle in 15 minutes, was over 4% immediately. So the stock had met our requirement of a gap up. The stock has elevated volume, which is significantly above average. And then you have the RSI divergence leading to a very strong move. Our entry is right on the open through those pre-market highs, and the stock price moved 4% direct, and then actually also created another opportunity intraday, which is another type of playbook trade that we have that created a nice scalp for a flag breakout. But as you can see with the opening drive, this was very straightforward. It met all the variables that we look for in the trade, giving us confidence to go long right off the open and catch a very big profit. Another example we have is Boeing. Really impressive opening drive here. So you have the stock gapping down. Variable number one, stock is gapping down 4%. The price of the stock is clearly trending lower, as you can see in the pre-market. And then we have relative volume elevated up to 16. At one point, it was up to 36 in the pre-market session, so obviously much higher than normal. We typically want to see this above at least 2 or 3, in this case very elevated. The pre-market has a support level here at 166 with the price testing a couple times, and then you can see the bearish divergence with RSI. It's a little easier to see on the 15-minute chart, so let's go to that. But you can see here that the RSI put in a higher high while the price stayed flat, and it actually started to dip lower. Then right on the open, you can see that little move up allowed the RSI to get overbought fairly quickly, and then giving it a lot of strength to go much lower from there. We entered the trade short put options on the break of the pre-market lows, and the stock moved over 4% direct with virtually no bounce. So really, really impressive. Another great example.